All right, let's get started. Good morning, everyone, and welcome to today's Tuesday Market Outlook session. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play, and today I am going to be walking you through how I am viewing the current markets. So before we get started, just a quick disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. So our agenda for today, we'll be kicking off with the major equity indices, highlighting those key levels, and we are seeing some pretty interesting price action since the last time we spoke. From there, we'll be moving on to fixed income, commodities, and Bitcoin as well. We'll take a look at the sector rotational model, highlighting which sectors are outperforming and underperforming the overall market. We'll take a look at some subsectors of interest that I have for you today. And we'll end today's session with some bullish and bearish market observations. So before we get on to the major indices, just taking a look here at the Fed rate hike probability for the next meeting, around 2 weeks away on the 1st of Feb. So the current target rate is currently 425 to 450. And right now, Fed futures are pricing in a very, very high probability of only a 25-point hike, which will take the target rate to 450 to 475. Fed futures are pricing in that probability being at 92.2% compared to a 50-point hike, which is only at 7.8%. So definitely more of a bit of a pivot from the Fed, and we are seeing equities react positively to that. Also, we have navigated through the high impact news events such as jobs and inflation data that could have potentially seen this chart show a high probability on the 50% side, or potentially have made some changes to this chart. But right now, the fact that there aren't any high impact news events for the interest rate hike until Feb 1st, I do think we'll most likely get a 25-point hike. Now, how does this correlate to price action? Well, markets have been pricing that 25-point hike for a while. You know, we knew in December that there was a likelihood of getting a 25-point hike, but in December, there was still a few news events and some economic data that could have changed that. Well, right now, we don't have that anymore. And for that reason, we are now seeing that rally as markets are now pricing in a more dovish Fed come the first meeting. So we know we're going to get we most likely will get a 25-point hike. The main thing that'll be in focus, other than the earnings season that we're currently in, will be what Fed Chair Jerome Powell says on the Feb 1st meeting and where they see interest rates moving in the future, and whether it'll indeed be elevated for a longer period of time, which is what they stated last time. So that forward guidance is what's going to really be monitored closely by markets. So S&P, we are seeing here a breakout above its 21 and 55-day exponential moving average. We saw inflation data coming out on Thursday, and intraday, it did move a little bit lower, but again, moving higher. And so far this morning, set to open a little bit lower. So we are kicking off earnings season. We have, as usual with the banking earnings announcements, we do have some fairly mixed results, with Morgan Stanley beating expectations, but JP Morgan and Goldman Sachs not so much. And I think when it comes to this earnings season, the numbers actually don't matter all that much. We know we had elevated consumer spending heading towards the end of 2022. And I do believe that that may lead to a few earnings beats or a few earnings surprises to the upside. However, what you really want to be focusing on is the forward guidance. You know, and time again, we see companies that beat earnings estimations, but their forward guidance is poor, which is why we see the stock price actually decline despite the earnings beat. And I think that'll actually be an even bigger factor for this earnings season, because this earnings season is based off of last year's, the previous quarter's numbers, whereas we are expecting EPS contraction for 2023. It may not be reflected in this earnings season and only may be reflected in that following earnings season. So something to keep in mind. Don't worry too much about the numbers, but listen to the forward guidance. That's going to give a much better indication as to how price will react. So price action here for the S&P, set to open a little bit lower this morning, but overall in a bullish trend, breaking above that consolidation level. And for that reason, I do think price could head to that 410 area of resistance. Overall, it depends how good earnings season is to see if price would actually break above 410. And the next key area would actually be 418 on the weekly time frame. That is a 23.6 fib level, and you also have 428, 430. Those would be the two key areas to the upside that I'll be looking at. In terms of a break above 430 and back to the all-time highs, I'm less optimistic about that. I don't believe the economy is in the right state for that. We know that there is going to be some headwinds ahead. JP Morgan CEO even said that during the earnings announcement. So I would say I'm less optimistic about that, but in the short term, there is definitely a more risk on environment, and we are seeing equities and risk assets in general start to break out and move higher. Moving on to the NASDAQ 100, looking at the QQQ ETF, similar price action, price breaking above its 21 and 55-day exponential moving averages after once again finding support at 260 after a period of consolidation. So we do have a previous area of support here, 280, which could potentially turn to resistance. I would define that as a very minor area of support. Wouldn't look too much into that level. But for now, the fact that we are seeing price bouncing off a major area of support, as you can see in the weekly time frame, and showing that upward momentum, daily momentum turning positive, I would say that there is enough evidence for a higher probability of a breakout above this minor previous support area that could turn resistance. And we would be looking for a revisit back to that 295 to 300 level. So that would be the next key area to target here for the NASDAQ 100. Taking a look at small caps, looking at the IWM Russell 2000 ETF, and we are seeing some impressive performance, or relative performance, I should say, for small caps relative to large caps. For so long we saw that underperformance, especially in 2021, when large caps were making new all-time highs every other week, and small caps were just unable to break above this range. And then we saw a decline, which was in line with the overall bear market. So we saw fairly equal performance for small caps relative to large caps. If anything, there was a bit of capitulation in terms of relative performance. And now we are seeing a bit of a breakout here for small cap performance. Price back at that 188 key area, which is the 38.2 fib level. Again, potential to act as resistance. As you can see, price is moving a little bit lower this morning. However, if we do start to see, a few more earnings beats, that would provide a good fundamental catalyst to see a breakout above 188, or potentially even a Fed pivot or a dovish Fed. So keep an eye out for this 188 area. As for shorts, I wouldn't say I'm too tempted by adding shorts in this current environment. It does look like equities are on a risk-on mode. There's some momentum there, and momentum hasn't reached an overbought condition. So if it was an overbought condition, if the 50-period CCI was at a 200 area, I would say, okay, risk to reward does favor a short-term bearish opportunity. But the fact that it hasn't reached there, it's only at 100, I would shy away from shorts from the current area. Even if we do see a pullback, I wouldn't be surprised to see a retest of 188 very soon. Next key area to look at, should price break above 188, would be the 200 key psychological level and also previous swing level. And you also have, of course, 210, which is a 23.6 fib level, acted as a major area of support during 2021 and also resistance early 2022. All right, taking a look at TLT, the bond ETF, and finding some momentum. I am seeing capitulation here for TLT, but thesis remains neutral, because if you take a look overall in the weekly time frame, the bearish structure remains intact. We saw price did rebound quite recently to the previous swing low, failed to break above it, moved a little bit lower to 102, but it's still staying that level. It's actually not making a new lower low. So that is a sign of capitulation, or at least a bit of a base formation for TLT. I'm not overly bullish despite the recent bullish price action here, but I do think the worst is over, at least in the short term, unless something drastic happens with inflation and we see the Fed get very hawkish for no reason. But for now, I think TLT is reasonably priced. You have resistance at 110, support at 100. Wouldn't be surprised to see a more range-bound market over the next few weeks here for TLT, or potentially a breakout and a revisit back to that 120 major resistance level. Moving on to the US dollar, and I'm quite surprised by this. I'll admit that I had a more bullish case here early 2023 for the US dollar, especially after what has been a significant pullback. But the Fed being more dovish than anticipated, or I should say, inflation coming down better than anticipated, has really seen the US dollar's price fail to find that upward momentum. You can see it did try and move up a little bit higher, trying to break back above 105.50, failed, and very bearish price action to actually break below 104.50, which was a short-term support level. Failed retests a few days ago and continuing to move lower. So price action is definitely quite bearish. Question is, how much lower can it go? I see major support at an area between 100 and 102. I'll be surprised to see it break 100. I still think the US dollar has a case to be somewhat elevated, but the fact that equities are doing well, and generally speaking, when equities are doing well, it has an inverse correlation with the dollar, and the US dollar does tend to drop as well. So there is a couple of headwinds. Also, the fact that the Fed isn't as hawkish as anticipated. The fact that inflation's improving. We are seeing continued. Let's put it this way: we are seeing a lot of headwinds for the US dollar to continue to move higher. However, I think there is still a case for price to be elevated. And taking a look at gold. So gold, there is a lot of momentum behind this move, and price actually on the daily time frame on Friday did reach an overbought condition with the 50-period CCI at 200. So normally you would expect to pull back at around this range, which is what we're seeing so far this morning. But still, even if you look at the pullbacks over the last few weeks, it hasn't even broken below that 21-day exponential moving average. And that speaks to the amount of momentum that is behind gold right now. And remember, gold is a safe haven asset. So even though we are in this risk-on environment, or short-term risk-on environment for early 2023, we are still seeing that stealth rotation into gold. So investors are still concerned about what the medium-term outlook is looking like for global markets, and rightfully so, because we've seen plenty of CEOs come out with their forward guidance even before this earnings season, in the previous earnings season, say that 2023 will be a difficult year. The big companies, the big tech companies, have stopped hiring. These are significant indicators that we can't ignore. So for that reason, I do expect gold to continue to move higher, but in terms of an entry point, it's been extremely difficult to find that, because it just hasn't pulled back far enough to justify a nice bullish entry point. Hopefully we get a further pullback here for gold, potentially back to 174, which is a previous key level, provided resistance and support recently. And you also have 171, which is another key level. So those would be the two key areas that I'll be looking at to enter a bullish trade for gold. But for now, the fact that price has reached an overbought condition, it makes no sense to enter that bullish trade just yet. Possible upside targets would be at 182. That'll be the key level that I'm looking at. Provided resistance in the past. You have 192 as well, but that's a pretty extreme condition. So 182 for now, we'll see how it goes. Right, and taking a look at oil, you're looking at crude oil futures, the continuous contract. Now, bearish price action overall, but over the last few days, we are seeing price be fairly neutral. So price did manage to bounce at the 72 level, heading towards that 80, 81 area, which is a short-term resistance level. So I do expect price to be relatively range-bound. On the one side, you have recession fears that naturally drag oil price lower. However, on the other side, you have potential for a soft landing for a recession, and you also have Chinese reopening that is pumping price a little bit higher. But right now, oil has definitely pulled back from those highly elevated levels, and overall, the price action is still quite bearish. I do expect to see a short-term move lower, but in terms of the medium to longer term, I wouldn't be surprised to see price reach that 61 area. And you want to think about this in terms of how does this impact energy stocks, especially those oil companies that have such a high correlation to oil prices. And it has a negative impact on them, right? Because we tend to see when oil prices move lower, energy stocks move lower as well. And we are seeing that rotation out of energy. So if we take a look at this sector rotational chart that is in a couple of minutes, you'll see what I mean. So if we take a look here at Bitcoin, Bitcoin has approached an extremely overbought condition. Very, very interesting price action here over the last few weeks in Bitcoin. Now we saw price was, made this huge topping formation, broke below what could have been a head and shoulders here and broke below that neckline at around 30,000, 28,000, moved all the way down to that 78.6 fib level and kind of found support, managed to break below it and stayed below the 78.6 fib level, but didn't really move lower. So found a base at around that 16,000, 17,000 area. But over the last few days, we have seen a resurgence in terms of momentum. Price actually managing once again to break above that 18,000 level. Significant momentum. Look at the 50-period CCI at around 600. So Bitcoin in the short term, it is severely overbought. For those of you that are looking to go long above 18,000, I say wait for a pullback. This is a pretty overbought condition here. Look for the pullback for Bitcoin. And, I do think that if you are, bullish on Bitcoin, keeping your thesis above 18,000 makes sense. In terms of areas of resistance, we actually have resistance here at around 21,000, but you also have resistance at the 25,000 level. So this area here, that'll be another major area of resistance for Bitcoin. And I'll be surprised to see price actually break above that. Yes, we are having a risk on environment, but how long would that last for? In my opinion, only a few weeks, maybe a couple of months. We still have recessionary fears and high interest rates to deal with. Okay, taking a look at sector rotation. Now we have 8 sectors in the improving and leading category and 3 in the lagging and weakening category. And energy, the big one in the weakening category, significant rotation out of energy. And that speaks to the fact that oil has been slowly but surely declining at a time when markets have been either staying neutral or moving higher. So relative performance for energy has definitely dissipated, even though it was pretty much the best sector for 2022. We are seeing healthcare as well rotate into the weakening category, which is a defensive sector. Staples, the other defensive sector, showing some outward rotation as well, but not too much, nothing to worry about there. And utilities finding some momentum here in the last few weeks and relative strength, looking likely that'll move into the leading category. So interesting to see utilities improve. I think this comes down to the fact that we know where interest rates are going to go, and that provides some certainty for municipal bonds and their valuations. So that is why we are now seeing utilities find some more momentum, because investors know how to price them now. They know where they're going to go, where interest rates are going to go, and it makes it easier to assess municipal bonds. Now, taking a look at financials moving lower, likely heading into the weakening category, unless we see the big banks produce other upside surprises for earnings. Materials and industrials also in the leading category. Discretionary, still the weakest sector here in the S&P 500, moving lower and finding some relative momentum in the last couple of weeks, but I wouldn't read too much into that. The reason discretionary has experienced such a severe outward rotation is due to the fact that we believe that consumer spending will slow down significantly in 2023. Markets are pricing that in now. And, overall, when interest rates are high, consumer spending is going to decrease. So for that reason, even though we are seeing that upward momentum in discretionary, I would not read too much into that. We have real estate and communications showing some momentum. And you also have technology. Not a lot of momentum here, kind of flirting between the lagging and the improving categories. So let's see what happens again with earnings season. This may see a huge shift in terms of rotation. But for now, especially comparing it to last week, we actually haven't seen that much of a difference in terms of sector rotation. Okay, taking a look at some subsectors of interest, a name that you're all familiar with by now, it's a name that I've covered quite a bit, is KWEB, which is a Chinese internet ETF. So this was a bullish idea that we had. We saw an initial sharp move higher, followed by a pullback, followed by another move higher to break above resistance, followed by some consolidation, and gain another move higher here. So our target here is at that 40 level, major area of resistance, and does look like price is heading towards that, despite this pullback this morning. So overall, still a position that you want to keep a hold of, and overall the thesis remains intact for KWEB. Taking a look at IBB, which is the biotechnology ETF, I had a bearish thesis on this last week due to the bearish price action. We saw a huge rejection at 133 and a doji candle, followed by a huge bearish candle there. But since then, price has actually rebounded quite strongly, breaking above 133. My bearish thesis remains intact, and that comes down to the fact that from a relative performance point of view, IBB has not, over the last couple of weeks, IBB has not really performed that well against the overall markets. We are seeing a slowdown in relative momentum, especially with healthcare, as you saw with the sector rotational chart. So I would say I would keep my bearish thesis until 138. If price does break above 138, that would signal a move for 143 to 146 being on the cards, and that will invalidate my thesis. But for now, yeah, it broke through an area of resistance, but there is still another more recent area of resistance to contend with. And KRE, so again, another bearish idea that I had from last week that has somewhat invalidated the thesis. We saw a bearish price action at 60. That was my entry point for a move lower. And for those of you that did trade this, you know, my reasoning was that when price breaks above 60, you could close it. And I would say, you know, it makes sense to close it now for a very limited loss. You know, it's still early, so the loss shouldn't be too substantial at all. However, we also have bank earnings. And even though it doesn't necessarily impact regional banks as much as the big banks, it's still going to have some impact. And for that reason, you know, if you do want to keep it open, see how bank earnings go, we could see KRE eventually break back below that $60 level and potentially move lower. But if it breaks above and closes above 61, definitely close out KRE. In terms of short-term targets, we have the previous swing low at 57, also double bottom. And we also have 54 major support on the weekly time frame. Moving on to Visa. So Visa, another bearish idea that I had. The bearish ideas just have not been working so far, but we saw last week a huge rejection of 223. Price did manage to trickle back above that. Looking at its relative performance, so nothing too impressive against the overall markets. You know, Visa is very much exposed to consumer spending. So a slowdown in consumer spending most likely does result in a decline in price here for Visa. So maybe from a timing perspective, you know, we could be incorrect, but overall, I think Visa does have the potential to decline throughout the year, or at least for the first half of the year. Price is overbought at 200, the 50-period CCI. So the risk to reward does still favor the downside. And this is a trade that I'd probably still keep open until price breaks above that 224 level. So the previous week's high, that's what I'd be looking to close out Visa. But for now, the bearish thesis does still remain intact. Okay, taking a look at NVIDIA, which I think is a very interesting name. So I've been bullish on NVIDIA now for, you know, more than a year now, I would say, especially during the semiconductor rally. But valuations did get a little bit too steep. Naturally, we saw a significant outward rotation for 2022 for technology stocks, especially semiconductors. But price did reach an area of support at 121, which I do believe will be the floor. Now, we also have an inverted head and shoulders formation on the weekly time frame. And even on the daily time frame, we can see that as well, with price most recently finding support at that 140 area. From a fundamental perspective, though, I think NVIDIA is a fantastic pick in the semiconductor subsector. It is continuously taking market share from Intel. It is focusing on the next gen processors and GPUs. And it also, something to think about is Obviously, there's been a whole lot of talk with ChatGPT, which is an AI chatbot, and it can do quite a lot. It's very, very impressive, in my opinion, one of the most disruptive technologies that we could have in the next decade. Maybe not this instance of this AI chatbot, but if Microsoft or Google makes something that can incorporate that into your search engines, who knows, there's quite a lot of possibilities. But NVIDIA makes the types of processors that are used for AI chatbots. So there's a huge potential long-term value proposition here for NVIDIA, which is why it is a long-term pick. The fact that it's made this inverse head and shoulders on the weekly time frame indicates capitulation, and also indicates a nice time to potentially get into a longer term trade like this. However, if you're looking for a more short-term setup, I'm still bullish here on NVIDIA. We have resistance at 190, and that'll be my outside target. Price breaking above its 21 and 55-day exponential moving averages is encouraging for that move higher. We also have 210 as the next key area, but and from there, a few other key levels to look at. But I do like NVIDIA at current levels from a valuation perspective. Fundamentals look good, business case looks good, and technicals are now finally starting to shape up as well. All right, taking a look at MSCI, a bullish idea from last week. And we were bullish on this after this consolidation period resulted in a breakout above its 21 and 55-day exponential moving averages. So far, that has worked in our favor. I would say keep holding on to this. There is still some more upside until 520. 520 is when you'd want to take profits on this trade. That is a key area of resistance on the weekly time frame. And or you'd at least want to take partial profits, see if there's a potential breakout. If there is, then there's plenty further upside here. But for now, I would say 520 would be that key target area. And finally, we have DXCM, Dexcom. So Dexcom was a bullish trade, with the thesis being that price stays above this 110 area. It did break below it, which was always going to be a possibility given this gap. And we have seen that gap fill at 104, perfect bounce from there and a move higher. So bullish thesis definitely remains intact, showing bullish price action after the gap fill. And that for me does indicate that we could still see potentially a move higher here, with 116 acting as minor resistance, as well as 124, 125, that area as well. So with that, that is all I have for you today. Thank you so much for joining me, and I hope you all have a great trading week ahead. I will see you all next week. Goodbye.